Hi, David Moore of Equity Advantage. I'm here today with Robert Smith of Peregrine Private Capital. I think this is going to be our last segment today. So we've been talking about diversification, but I've got another form of diversification that you might be able to help me or those out there with. In addition to, DSTs, you are working with some other products these days, OZs, opportunity zones, and also UPREITs, right? And so if we talk about, and people ask me all the time about a DST, and I say, well, it's sort of like an exchangeable REIT. We can't exchange into a REIT directly. If you want to exchange in a REIT, in a nutshell, you're going to buy an asset the REIT absorbs, and the process is called an UPREIT. And I sort of look at UPREITs, they're an end game, and that's one of the topics I cover in my in-game presentation, but it's a dead end. And what I mean by that is you get into it, there's no way out without tax. With that said, I think it's the ultimate installment sale. But why don't we talk a little bit about UPREITs, OZs, opportunity zones, the DSTs, and compare DSTs also. Some people out there might still be looking at TICs too, tenancy and common investments. Yeah. And if we look at the inception of TICs, is you and me going to buy something together, right? And then it sort of mushroomed into something else. We ended up with a Rev Proc, and then that whole industry sort of blew up and changed. But there's still institutional TICs being offered. So gave you a whole bunch. You mind elaborating on a couple of those things? So TIC to DST, sort of compare, contrast, and talk about OZs and the UPREITs also.
TICs, tenant and common properties, are still alive and well, albeit the offerings are very limited, and they are much smaller in scope now in terms of number of investors. The inherent flaw in the tenant and common format is that for any fundamental change to occur with regard to the property, you have to have unanimous consent on the part of all investors. So prior to 2008, when the TIC format was being used along DST for large property offerings, you could see where it was going to fail, because most people go into transition. DSTs exist because sooner or later, inevitably everyone ages out of management, meaning managing your own property in your 20s, 30s, 40s, 50s is okay. It's not okay in your 60s, 70s, and 80s. And that's when you start looking for us and looking for DST. So people want to transition out. They want to unplug emotionally and psychologically. And you could look at TICs and say, oh, this isn't going to work, because if we have to make a big decision with regard to the property in terms of tenanting, financing, anything like that, we've got to have unanimous consent on the part of all these investors who are doing it to emotionally check out. And that's going to be like herding cats. And that's exactly what happened in 2008, and why so many TIC properties failed, not because they were inherently bad properties, but decisions specific to the management of that properties had to be made in a timely manner, and that oftentimes wasn't possible with the investor group, because you always had an outlier, someone who was a spoiler, or you just couldn't get everyone together at one time. So the current TIC offerings that you see tend to be much smaller, meaning a handful of people, 3, 4, 5 friends, family members, that kind of thing. And they're usually, as you mentioned earlier, they're usually a value add play. They're not a fully stabilized asset like a DST. It's being bought with the idea of it can be improved structurally, and in so doing, we can demonstrably increase rents and values. So it's usually a value add play. So they still exist, albeit in much, much smaller form, with a very small ownership group that makes management of it practical, where it wasn't before. And I'm not even sure if banks lend on TICs anymore. How?
Well, the funny thing about obviously TICs is that I mean, we look at small assets. I mean, vesting is our second biggest headache in the exchange world, right? So vesting is just simply the way you own an asset, and it changes how we address it, whether you live in a community versus non-community property state even. But if we're talking 4 units or less, typically it would be a TIC structure, TIC ownership structure, bigger stuff. You're right. I mean, a lot of it, they're going to require ownership via LLC. But so it would require probably portfolio lenders if it's large assets, and they're probably going to be the ones involved if it's a value add play anyway. But it's different, and the main point is that they still exist. It's just different type of product class. And I think if you're concerned about your ability to sleep at night too, one of the things that I wasn't aware of with the whole DST, but since it is a stabilized asset, you're pretty much impervious to any type of capital call too, which during the last crash the TIC companies were having, or even if you're part of a condo association, or HOAs, you might have that type of thing come in. But on the DSTs, you're pretty much impervious to that, right?
Yeah, you make a very good point that in 2008, when the single-family housing market collapsed, there were lots of cash calls relative to TIC properties, and many investors either weren't in position to answer that cash call or simply weren't inclined to throw good money after bad, and that's why a lot of TIC properties went down. And with DST properties, that's much, much, much less likely. And in addition to that, the nature of the bigger providers in the DST space, the institutional quality of the property management, and the capital structure of some of the bigger DST companies. They're well-capitalized entities. And so in 2008, the last time the market turned down significantly, and they had challenged properties, several of those companies had the existing capital structure outside of DST offerings to mitigate that or remedy that for investors. So the likelihood of that happening with a DST product, I can't say it can't happen, but the likelihood of that happening with a DST product from one of the large established syndicators, what we call heritage players that have been in the space pre-2008, I think is fairly low at this point. So.
Yeah. Well, that's good, especially if we're looking at things in the lofty arena we're in right now with prices on whether we're talking. I mean, obviously Wall Street's had a rough week, but it's still pretty darn high, and we're looking at a real estate market that just continues to blossom, I guess I should say. So.
Well, historically, leveraged real estate has been a great inflation hedge because you get to play exactly the same game your government's playing. Government, as we all know, talks out of both sides of its mouth at the same time. They tell the great unwashed us that they don't want inflation, where in reality they need inflation to inflate away that $30 trillion and counting in debt that's been run up over the last decade. And so with leveraged real estate in an inflationary environment, you get to play that same game. You're paying down, or the DST can be paying down the mortgage debt that encumbers it with dollars that are worth less day after day, month over month, year over year. And so you're actually inflating away some of the debt that encumbers that property, just like your government's doing. And that obviously works to your advantage. We've actually had some clients, very, very sophisticated real estate clients who come out of large 1031 exchanges, oftentimes with you guys, more often than not with you guys, that have very low loan-to-value ratio and have instructed us specifically to look for properties, replacement properties with higher loan-to-value ratios because they want to capitalize on the advantage that leverage gives them in an inflationary environment. And these are some pretty successful people.
So I do a presentation on end games and talk about a variety of different things. Ultimately, I talk about DSTs in that presentation. We talk about institutional TICs, talk about different forms of installment sale, everything from a traditional installment sale to a structured sale. We actually, you and I had a conversation earlier about the other DST, the Deferred Sales Trust, which that would be another conversation for another day. But an UPREIT, like I said earlier, is sort of the ultimate form of installment sale. You literally have shares. Your real estate interest gets converted to shares of that REIT, and you literally sell those shares at your leisure, pay the tax at that time, which is, you don't have to worry about a buyer defaulting, you don't have to worry about a loan accelerating or anything else. I don't know how many times through the last 30 years I've had people sell on a note trust deed thinking they got another 10 years of income, they didn't put an acceleration provision in it, and boom, they get a balloon payment, now they want to do an exchange. And I'm sorry, if you sell on and carry a note or a contract, as soon as that thing is yours, the taxes are yours, just question when you're going to pay the tax. We can't back into an exchange with a balloon payment in the future. But, one of the other things that I just want to, have you mention, I know you've got product available in the space, and I'm not a huge fan of them. Number one, because it's all about me. I lost personal property exchange. We talked about cars earlier, right? So I like cars, I like airplanes, I like helicopters, and it was lots of fun to do exchanges of those things through the years, right? And all those things were eliminated in 2017, and now we have the OZ in place. And so my perception, or the way I look at OZ, I think it's a great play if you're selling something outside of real estate. You want to get into real estate, right? But it is a product. It's something that people are talking about. You need to be aware of it. And the ultimate tax deferral is only good if you've got a successful development play. So you got to understand it's a development play. You're going to be there for a while. But you have OZ offerings too, Bob. So if people are looking at diversifying, you can help them. Just not only geographically and type of real estate class, but you've also got products, the DST, you've got the UPREITs that you've got offerings on, and you've got the OZs too. So any comments you'd make on the OZ, just as far as, have you had much in the way of demand in that space or not? Or, people ask about it and then they hear about it and they don't go that way, or what's sort of happening in your experience?
It's a very popular product. Our broker-dealer, Emerson Equity, out of the Bay Area, has a comprehensive Ozone product offering. As you mentioned, it's a great opportunity, particularly for tech types in the Bay Area, Seattle. They've got highly appreciated stock and they want to sell it, but they don't want to take the tax hit. And you can take something like that and then enroll it into an Ozone and certainly defer a capital gains tax liability that way. It's been very popular. As you mentioned, they're not real estate for real estate. They're not terribly compelling. The difference being that most Ozones don't produce any income. They're almost always a redevelopment play, or they're building something straight up out of the ground. So depending on the duration of it's a development play. So depending on the duration of the development, there usually isn't any cash flow associated with it for the first 4 or 5 years. And historically, most people that find the DST option compelling have significant cash flow needs. That commercial property that they're surrendering through 1031 exchange, or properties have been a significant contributor to their income stream, and they're looking forward to that continuing in retirement or in their more passive lifestyle. So unfortunately, Ozones, people ask us, what about Ozone? Nothing wrong with them, but real estate for real estate, they're not going to provide you any income, and that usually ends the conversation. Mm-hmm. And so it's not, we have comprehensive offerings that way. It's not something that we focus our business model on, and really it's not something that most people in 1031 exchange find palatable or desirable as soon as they find out that they don't cash flow, or maybe absolutely minimally cash flow, because the needs of the two groups that use them are different, because the two products are directed or are intended to answer different needs.
So I want to stress something Bob just said. The 1031 group's one thing, the OZ is another. They're not the same. You don't exchange into an OZ. It's just a process. So if you want to get into an OZ and you've got a 1031 in play at this point in time, what you're going to need to do is get access to the money. Otherwise, and keep in mind, an OZ has the same 180-day timeline that a 1031 has. So if you get money with your 1031 company and you've ID'd properties, you're now outside the 45 days and you don't want to buy what you ID'd, you're not going to get access to that money till day 181, which, by the way, is after you've got that limit to get into the OZ. So it's critical that you're looking at these options inside the 45 days. If you think you want to go into OZ or diversify into it, my advice would be pull what you want to throw into the OZ at closing, because you can only get money out of an exchange per 1031 G6 rules, which means at settlement or after you've purchased everything you have the right to buy. So I want to stress this once again. If you want to go into OZ, great, do it, but you got to know when you've got access to that money. And it's going to be either at settlement or after you've purchased everything you have the right to buy. And by the way, if you ID'd 3 properties and you got one of them, the other 2, even if they sold to somebody else, you say, hey, I can't buy them. That's not the government's position. A property does not have to be listed to be identified or acquired. So whether it's been sold or not is really irrelevant. You got to make sure you get access to that money somehow. And a lot of times what people are doing is if you had $500,000 with the exchange company you wanted to throw in the OZ and you don't have access to it, if you got $500,000 somewhere else, you shove that in its place, and then that way you're going to get the money invested and taken care of. But we have the same issues that come up with FIRPTA, the Foreign Investment Real Property Tax Act, because when the government requires those impounds, we don't get a green light to get that money. Doesn't get out often until the exchange is done. So the taxpayer's got to substitute other new funds to offset the impounded money.
Well, I think you make a very good point that you have to prepare whatever path you ultimately take, whether it's DST through 1031 exchange or taking some of the money and putting it in off zone. Preparation is critical, and we have people calling us all the time in advance of actually listing their property or properties for sale. And we tell them, hey, that you're in the catbird seat because you're starting the exploration process, you're starting the education process even before your property is listed. And that's at its best, that's what DST should be, is an educational process, because it is it's an opaque product. It's an alternative asset. There's not yet a ready secondary market for it. So you really got to do some homework to understand it before you pull the trigger. So the further in advance of any sale, you can prepare your game plan, whether it's DSTs, Oz zones, 721 UPREIT, the better served you're going to be, and the greater the likelihood is you're going to come up with your optimal solution when you do have to start pulling triggers and committing money. Yeah. That's a very good point.
So, DSTs, TICs, they're sort of a bookmarker. It's tax deferral. You're exchanging into them. When they go full cycle, you can choose to do another exchange or pay the tax. The UPREIT and the OZ are dead ends. And like I don't mean anything negative by that dead end comment. It just means that you go do one of them. At the end of the day, there's no way out without the tax at some level. And the OZ is interesting because if you've got limited deferral into it, but then what it makes on the thing, you go full cycle, it's sort of like a Roth IRA is the way I explain OZs to people. But there's a menu of options, so diversification can be geographical, it can be asset type, it can be product type too, as we just discussed. You could mix and match all of these things out there. Don't get misled by the 1031 ID rules. You think, well, the first rule is 3 property rule. That's all I can buy. Totally untrue. You can buy any number of properties. You can relinquish any number of properties. The ID rules just get tougher. And if we're working at, let's say, that 95% rule that I mentioned earlier, basically you got to close 95% of the aggregate value of all properties ID'd. Typically, a single sale fail could be problematic. So if you talk to Mr. Smith and you want to go buy a bunch of his stuff, talk to him. Don't do it on day 44. He'd be happy to talk to you on day 44, but give him some time to actually help you get out there and to show you what's possible and to give you the diversification that not only you might want, you might not even know is possible. So I want to thank you for time today, and I think we covered some great material. And if you've got questions, I always say the only dumb question is one that you don't ask. So ask the questions. You can reach out to Bob at
503-241-4949 or rs@peregrineprivatecapital.com.
And once again, David Moore, Equity Advantage, and thank you for joining us today. And we look forward to hearing from you. And here's to a bright and healthy future.
Thank you, David.
Thank you, Bob. Bye-bye.
You didn't even read my story. Good girl, these stars. I can see straight right through you. Took out my phone and I felt nervous and confused about